Hey guys, Coach Chris here. Now, first of all, I'd like to welcome you to my channel if you haven't been here. Today, we're going to talk personal finance. We're going to talk about the difference between a closed end fund and an open end fund, commonly known as a mutual fund. So, now the difference between a mutual fund or an open ended fund and a closed end fund is that a mutual fund will constantly issue a certain number of shares, as many as investors are willing to buy. When investors put more money into the fund issues more shares and buys more shares of stock in the market. Now, because of this, the price you pay for a mutual fund will always be the total value of all the stocks in the fund divided by the number of shares. This is known as net asset value, or NAV. Now, mutual funds or open ended funds always trade at the NAV. Now, closed end funds, they work a little differently. If you want to buy a closed end fund, you need to go into the market and buy the actual share. So they trade like a normal stock. And by definition, somebody else must sell you their shares. As a result of this, the value of a closed end fund can fluctuate significantly, and the share price does not necessarily reflect the NAV. Any difference between the share price of a closed end fund and the NAV is known as a premium or a discount, depending on the share price. If the share price of a fund is trading higher than the NAV, it's known as trading at a premium. Now, conversely, if the share price is trading lower than the NAV, it's trading at a discount. Now, in theory, this makes no sense because a closed-end fund should never trade at a discount and certainly shouldn't trade at a premium. After all, it would be foolish to sell a fund for less than it's worth, and it certainly wouldn't make sense to buy a fund for more than it's worth. Of course, in the real world, this doesn't always happen. Now, whether somebody's selling unrelated to the fund, be it a margin call, or selling out of irrational fear like the panic of 2008, 2009, closed end funds will sometimes sell at a significant discount to the NAV. Now, this is a huge opportunity for investors. Now, buying funds at a discount to their NAV is a great idea because in most circumstances, the fund will return to NAV. The market will realize that the fund's undervalued, or the fund managers will get permission to buy back stock and drive the price up. Either way, the share price is always certain to rise. All you have to do is buy it, hold it, and wait. Now, that's your financial lesson for today. If you like what you heard, hit the like button, obviously like, subscribe. And if you have any comments, questions, put them down below, and I'll try and get back to you as soon as possible. Now, this is Coach Chris, and I just want to say, take it easy, have a great day, and there's nothing that can't be overcome without the right coach.